afternoon and welcome to Biztech's Asian Midday Market Watch. I'm Brian Fernandez and it's Wednesday, the 8th of May, and our focus today will be on Australia. And to bring an expert lens to the conversation today, we have Glenn Yin, Head of Research and Analysis at AETOS Capital Group, coming to us out of Australia. Glenn, as always, great to have you on the show.
Thank you for having me again, Brian.
Now, Glenn, for a start, the Reserve Bank of Australia kept its benchmark rate unchanged at 4.35 yesterday. Now, so Goldilocks decision, neither hawkish nor dovish, despite the fact that inflation data was higher, Q1 inflation data was higher than expected. Now, we've heard rumblings around economists of as much as 3 more rate hikes in 2024. Break it down for us and tell us what your expectations are.
Yes, Brian, we had the decision out yesterday, and like you said, before the decision was landed, we heard lots of talking about 3 more hikes before the end of 2024. Certainly, very, very scary to think about. But from a reasonable perspective, that is a very low probability event. But we would like to share a bit more about what happened during the decision. Before it and after it in terms of market price actions. So very interesting trading day on Tuesday. We had the latest interest rate decision, largely in line with the market expectation. There was no change in the policy at 4.35%. Policy rate remains at 12-year high. But here's the interesting bit. Since the Q1 inflation data came out and beat expectations, we've been hearing, like you said, 3 more hikes, totaling 75 BP before 2024. That means taking the official cash rate to 5.1%, and that would be the highest level since 2008 during the Great Financial Crisis. This sounds ridiculous as we are already in a per capita recession. Our household consumption has been declining for several quarters, so another hike, let alone 3, will put significant pressure on Australian families. So yes, that's a low probability event, but we'll talk more about the price actions from FX markets and equity markets a little bit later. Yeah, so that's the overview from yesterday.
Now, and I'm going to take a point that you just mentioned. You really just talked about stresses on the Australian household. Last year, when mortgages reset as interest rates went up, Australian households came under a lot of pressure. But fortunately, we haven't seen the sort of stresses leading to actually defaults in terms of the mortgage market. We have, however, as you alluded to just now, seen consistent falls in consumer consumer spending, as basically households allocated more of their budget towards servicing their mortgages. Given the scenario that potentially the talk around 3 rate hikes, surely that's politically also not a palatable solution.
Yes, Brian. So definitely 3 more hikes, that would be catastrophic. But like you said, the Australian families, the household spending's been down. We have our per capita recession, all of these negativity surrounding the macroeconomic aspect of the Australian economy. But luckily, given that we had our mortgage cliff taking place predominantly in the Q4 2023 and the beginning of 2024, we haven't seen too much of a spike in terms of defaults. And that is a very, very good news, to be honest, and very comforting to see this. I think it could be attributed by the fact that most families, the ones that are surviving during sort of sailing in the stormy water, they could see that the initial buffer was depleted. The low rates that they signed up for fixed term 3-4 years during the pandemic. Now they could see that the RBA has hiked several times. It's 4.35%. not 5.1%, as suggested by those aggressive people out there. But they could see this coming, so they sort of have built up the buffer during these safety windows, which is really, really good to see. And I think that from the policymakers' point of view, they should be grateful and appreciate the Australian families staying very resilient. And this is part of the Australian spirit, staying there, hanging there, and maybe we'll have our rate cut coming as early as November, as most people, economists predicted, and hopefully we'll see that happening soon.
Now, going back to price action, which is what you alluded to just now as well, Aussie dollar against the US has gained 3% since May the 1st. We also have the ASX 200 gaining 300 points since May the 1st. What's happening in Australia that we should know about?
Yes, right. This is the funny thing. We'll talk about three hikes that that's very, very unlikely. But this is speaking from the common sense perspective, from the viewpoint of financial markets. Which normally doesn't have too much common sense. If we look at the Australian dollar against the greenback, we could see Aussie dollar gaining 3%, as much as 3% since the 1st of May. Of course, there was the non-farm payroll from last Friday, which we saw a surprise jump in unemployment, which dented the dollar sentiment. But markets are just pricing in too much for the AUD, in my opinion. It remained highly bullish until the decision was landed. The interesting bit is on the equity side, take the ASX 200 futures, for example, which traditionally has a negative correlation with interest rates. Now, we saw continuous rise in the index, rising more than 300 points since the 1st of May. So the same sort of time window, once both are going up. No, that's not right? And it's a paradox, because FX markets were pricing in for a hawkish RBA, while the equity markets were pricing in for a dovish RBA. A major discrepancy, which is likely to cause more confusion ahead of the federal budget next week.
So now, speaking of the federal budget next week, Australia, the lucky country, one of the few countries in the world that's actually running a federal budget surplus, which is amazing. Give us a sense of what are the expectations around the budget, and your thoughts on where this budget surplus perhaps could be deployed.
Yes, right. The very lucky country, if we look around the global stage, you will see most developed economies running deficits. Look at the US, debt ceilings have been hit several times. The debt is close to $40 trillion. They'll be hitting that mark very soon. So look at Australia. We are having the budget surplus, and this is the second consecutive surplus in 15 years. So it's well done. Kudos to the federal government. But most important thing is this: how to walk a narrow path between saying, subsidizing the economy or helping out the Australian families while not stimulating the economy and reigniting the inflationary pressures by on the fiscal policy side of things. So we'll be focusing very, very closely on this. And another key focus of the budget will be in the details of the very recently proposed Future Made in Australia project, which the government is trying to bring back, trying to revive the Australian manufacturing industry, which can be a big challenge. But the way how it will allocate funds and how it will stimulate these particular manufacturing sectors will be the key focus. Take the solar panels, for example. This is a very hotly debated. The government is projecting a competitive advantage in terms of prices compared to China. So which is, if we can produce it here, we have plenty of sunshine, we have plenty of land. That could be the first and very important step in reviving the Australian manufacturing industry. But in terms of the Australian dollar, FX markets, we will be focusing on how and where the government precisely spends that surplus, or whether it will spend the surplus at all. That will be the key driver for our Aussie dollar.
Now, Glenn, it's always great to have you on the show. Thank you very much for your insights.
Thank you, Brian, for having me.
Now, we've been speaking to Glenn Yin, Head of Research and Analysis at AETOS Capital Group Private Limited. This has been Biztech's Asian Midday Market Watch. I'm Brian Fernandez. This show will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.